Good afternoon, folks. How is everyone doing today? uh, I kind of revived a thumbnail for this that I'd used a while back. It's been 2 weeks of bad news in the markets, and wanted to talk about something else, not necessarily related to the markets, but may affect your portfolio, particularly if you have a lot of investments in oil. And so let me preface this by saying that I have owned oil stocks for a very long time because I worked for the oil industry. I haven't made any new investments in oil for quite some time because it makes up a large enough portion of my portfolio already through my individual holdings and through my ETFs. But um, this is the first time in probably 6 years that I have considered adding more US oil majors to my portfolio, and that's largely because I see a pretty large spike in oil prices coming up here in the future. Now, let's remember how I approached the subject earlier in 2022, say April, May, saying the prices are going to be really high. There was nothing stopping it from even getting higher. But by August, we'd start to see a decline in oil prices. That decline happened later than I expected, but it did happen. And oil bottomed out somewhere around $72 a barrel a couple of weeks ago. And we saw a little bit of a bump today, and that's mainly on supply concerns. And let me tell you something, those supply concerns are going to get worse. So let's remember the oil market is governed, just like everything else, by fear and by greed. When I say that oil supplies are limited, I'm not saying we're going to run out of oil, folks. I'm just saying it's going to be more expensive to get it, right? It's going to be more in demand. It's going to be more expensive to get it. And there's a couple of reasons why that is. So U.S. oil production right now is, everything that's being done in the lower 48 is actually really, really healthy at this point, and it's near levels that we saw prior to the pandemic. And a lot of that has to do with caution on the part of oil companies. They've been really reluctant to invest in further oil production in this downturn. Number one, they thought in 2020, and rightfully so, that the decline in demand was going to be relatively short lived. It was longer lived than they planned on, but they were right. It's not going to be permanent. And the snapback, when that came, they decided that they didn't want to over invest in capacity because of what happened in 2008, where there was just this massive overinvestment in capacity. We saw a collapse in demand, and lots of these smaller companies went out of business, and under the effect of the bottom line of a lot of larger companies as well. This time, we're not in that same situation. We're in the opposite situation. There's been an underinvestment in capacity and drilling for really the past 5 or 6 years, not just since 2020. And there isn't a lot of excess capacity around. I'm talking about in the United States and worldwide as well. Okay, so let's take a look at what happened sort of in the first half of 2022. U.S. oil production averaged 11.1 million barrels per day, up from an annual average of 10.8 millions per day in 2021. And this was a lot in this lighter crude as well, which a large portion of that can't actually be refined here. You actually have to ship it overseas to be refined. So over the first half of 2022, U.S. production of light crude oil with API gravity under 45 degrees increased by 185,000 barrels per day to 3.1 million barrels per day, accounting for 28% of production in the lower 48. Conversely, production of the heaviest crude oil category with an API of 30 degrees or lower fell by 33,000 barrels a day. So U.S. crude oil supplies have remained relatively stable over this period, with lighter oil actually becoming more prominent in our supply than heavier oil. That's something to talk about. So the White House has put out a lot of information on oil that you have to wade through the BS there to really sort of understand what's going on. They've tried to put all of this on the military buildup and saying that this is Putin's price hike, whatever. It is only to a degree. All right. And let's remember that Putin and Saudi Arabia got into a spat just prior to the pandemic. It really started, I think, in September of 2019, but by January, February of 2020, Russia actually was outproducing Saudi Arabia in terms of oil in an attempt to blow through the floor there and to take out U.S. Shale producers. And I have to believe at this point that was part of the plan all along, was to take a lot of these shale producers out of business to make it to where it would be very difficult to bring our excess capacity online. And then when he probably would have started the war in Ukraine earlier, once those oil companies were out of business, in order to put more pressure on the West to come to the negotiating table or do whatever it was he wanted to do. Um, but I think that those plans were interrupted by COVID, right? So there was a massive drop in demand. The At one point, oil prices dropped so low that because of storage costs, oil contracts dipped into the negative at one point. And the Trump administration actually allowed oil companies that had all of this excess oil to store oil at no cost in the Strategic Petroleum Reserve. That's a fact. Look that up. I didn't include any links on that today, but he did that at no cost. And then he tried to buy the oil at something like $24 or $26 a barrel. The oil companies were like, no, thank you. We're going to sit on this for the next 6 months and sell it at 2 or 3 times the price later on, which is exactly what they did. They got free storage for their oil over that time period, and they got to sell it later on at healthier prices. So the opportunity to fill up the oil reserve at that point was missed because of the decision to allow these companies to store oil basically for free. Now, I'm not necessarily criticizing that decision. That helped a lot. The drop off in demand could have lasted a lot longer than anticipated. It could have, and in that case would have helped them, make it past that. So this is not really a Putin price hike. This is a price hike based on the fear of what taking all or some of Russia's global oil off the market. And that's what really happened. People are buying futures contracts based on where they think supply is going to be sometime in the future. I just looked up, futures prices for delivery in July, August, and September, and right now they're still hovering around $72 to $74 a barrel. I think that futures prices by July, September, October of next year are going to be far higher for a number of different reasons. Chief among them being that the largest oil producer on the planet right now, which is Saudi Arabia, doesn't have excess oil capacity. They just don't have it. So they probably hit their limit based on what we asked of them in way back in July. And they're producing about 12 million barrels per day at this point. Their suggestion, even then, that Saudi Aramco may not, and then the Kingdom of Saudi Arabia may not be able to meet their oil production promises. And basically, they claim that they could pump about 12 million barrels per day. They're pretty close to that. That was well above their August target of 11 million barrels per day. They're pretty close to that at this point, and they probably don't have excess capacity. And that's one of the things. And they were talking about this way back in August of last year. So they're at that target of 11 million barrels per day. The limit is probably 12 million barrels per day. They just don't have, and they've only done that once before. They were able to sustain that for roughly, I think it was like 90 days or something before they had to come back down. But yeah, there's a lot going on there in terms of production. Like I said, they pretty much hit the limits as where they were before. They were briefly above that period back in 2020 during the Saudi and Russia oil price war, where they were both trying to outproduce each other for as long as possible. That oil price war may have been really, really significant had it been allowed to go on much longer. And but it didn't, because this giant drop off in demand because of COVID. And now we've seen this return to production overall. We've also seen U.S. production grow, but we have seen U.S. underinvestment in production over this time period. So this is kind of the real issue here. The Energy Information Administration shows a decrease in global surplus crude oil production capacity by 2022. Okay, in 2022, and this is what it looks like in 2022 right here. This is a really faded line that you can barely see right here. The excess capacity between 2022 and 2021 has basically been cut in half, mostly by just the increase in production of people who are using that capacity. But second also is that some of that excess capacity has been taken offline because of sanctions on Iran, sanctions on Russia, and sanctions on Venezuela. So, three oil producing countries where we have large amounts of that had surplus capacity. So, surplus capacity in non OPEC countries decreased by 80% compared to 2021. The data show that in 2021, 1.4 million per day surplus production capacity was available in non OPEC countries, 60% of which was in Russia. And that is now gone because of sanctions on Russia. So, as of May 2022, we estimate that all surplus production capacity in Russia was eliminated due to the sanctions implemented after Russia's full scale invasion of Ukraine. And we determined that excess oil production capacity declined in other non OPEC producing countries as well. We estimate that as of May 2022, producers in non OPEC countries had about 280,000 barrels a day of surplus production capacity. So, and they define surplus production capacity is things that can be brought online within 30 days and sustained for at least 90 days. That's the other thing. Just because you can bring production online doesn't mean that you can sustain it over time. And we've seen that in a bunch of like peak production periods like we had in Saudi Arabia. The volumes, their assessment of current surplus crude oil production capacity does not include volumes of oil that are offline because of unplanned outages or disruptions. We're talking about refinery outages because of maintenance or accidents or disruptions because of natural disasters, which we've had a couple of light years in terms of hurricane activity in the Gulf of Mexico. That's going to end at some point. And this also includes sanctions because volumes cannot be brought to market voluntarily. For that reason, they exclude crude oil production that is offline in Iran, Libya, Venezuela, and now Russia from surplus capacity estimates. So this is the reason why we're seeing some action on the diplomatic front with Venezuela. I think I've mentioned this on the channel before that I really don't see a reason why the United States has brought sanctions against Venezuela other than the fact that we don't like their politics. We deal with a lot of people that have issues in terms of human rights, and Venezuela's human rights record is certainly no worse than any of the Gulf states or Russia for that matter. So I don't see the reason to have sanctions on that. So likely we've started the diplomatic ball rolling there, but that's not going to solve any problems in the immediate term or near term. And I'm considering the near term like the next 2 years. It's going to take years, like 20 years, to bring Venezuela's production into the modern world and back to where they were like prior to 2000. And I think it's going to take a lot of money to do that as well. So there's no immediate help there. This is planning for the future. And since 2003, this organization has tracked OPEC surplus capacity. And this report comes out usually once a month. So that's one of the things there. And what we haven't talked about is the likely increase in demand from China. So I think it's really difficult for us to get an idea of what the scale of lockdowns has done to the Chinese economy because of how news is reported here. But one of the things that I notice is that even in places, and this is just from photos, and I could be getting a biased view of this, but just from photos and video. But even in places where lockdowns have been lifted in China, streets are empty at this point. There has been an increase in consumer demand in China related to the end of lockdowns. But a lot of that has to do with people restocking for all the things they would need in case of another lockdown. Now it appears that the Chinese government is bowing to public pressure to a degree and bowing to reality to a degree and reopening their economy. Now, I think it would be difficult for anyone to try to estimate what an illness like this is going to do to China. It could be relatively mild, but their medical system is already under pressure at this point. I think that we don't see a return to full demand in China for oil until the summertime. And I think that's going to coincide with some peak fear in the oil markets when we see summer offensives in Ukraine. We see other activities happening, the startup of the Atlantic hurricane season, all of that. There's a lot going on. And there's also troubles in Iran right now. Some of Iran's oil is, of course, making it to market. They sell about $84 billion a year of petroleum products on the open market. We should all be paying closer attention to what's happening in Iran. I realize that region, if you only view it through the lens of Western media, for the entire region of the Arab Middle East and the Persian Middle East, you probably don't understand the scale of what's happening inside of Iran at this point. And I think it's more dangerous than some of the periods we've had recently where there was unrest there. This seems to be baking in at this point into a real resistance. And we could see that area fall apart in terms of oil production as well. So a lot of risks right here mean that it may be a good time to take a look at U.S. oil majors at this point. I'm talking about, this is not a recommendation to buy, sell, or hold any of these securities that I'm talking about next, but take a look at Chevron, take a look at Exxon, take a look, not necessarily at most of your really large U.S. oil companies at this point. They are well positioned and to benefit. We have excess capacity here, not that much, but let's remember we could also be investing more into excess capacity at this point. And now probably looks better from a business perspective. The last couple of years, companies have not invested in expanding oil capacity. They've done a number of surveys when it comes to oil executives, and the questions were, hey, what are you going to, instead of investing in oil production capacity, what are you guys going to be doing? And the answer in almost every case was, we're going to return shareholder equity through either raising dividends or through share buybacks, which, okay, as a shareholder of some of these companies, I'm very happy about it. And maybe I thought that it was a short-sighted business decision then. It actually looks like a fairly good business decision now, because they've been able to go back to the well in terms of reducing their overall debt, shoring up their balance sheets, supporting the value of their stock. And now they're looking to go into an expansionary period as China's oil demand starts to recover and catch up to the rest of the world. Oil demand is likely to be higher. Even, everyone talks about the reduced oil demand because of a recession. Let's remember that is incremental in most cases and has a greater effect on fear than it does actual production or consumption, right? There's a larger swing in prices that should be justified by the actual, change in consumption here in the U.S. and elsewhere. This time around, we have significantly more risks, not necessarily greater risks. Not that each one is greater, but we have just more dominoes waiting to fall here than we've had in the past. Which, like I said, it doesn't mean we're running out of oil. I remember seeing back in right before the elections, this one news channel that I'm not going to name by name, but they kept running with this theme that the United States was running out of diesel, saying we only have a 26-day supply. What they don't realize is we pretty much always have between a 22, 24 to up to 32-day supply of diesel in this country. We are continually producing diesel. Prices will be affected by that estimated supply of diesel in this country, and they'll either up production or cut production based on that supply number. That number that they kept reporting was entirely within the natural range of diesel reserves or diesel supply that we always have in this country. There was nothing different about that. This time around, there's still nothing different about that. What I'm saying is that the lack of excess capacity around the world at this point is likely to lead to higher prices. I see that by May, June, July, we will probably see a return to $100 a barrel oil. Okay. That is what I see likely happening in the future here, as the effects of Russian sanctions are better understood, as we see a failure of one or two of the offensives, either from the Russians that's supposed to be coming right now relatively soon, or from a spring counteroffensive by the Ukrainians. We're going to know better how that's going to affect energy prices as well. I think that once the conflict clears winter and it's very clear that Russia will not have that energy weapon to use, I think that we might see a quicker resolution in the war in Ukraine, which could have positive impact on supply. But I don't believe that sanctions are going to disappear overnight just because we have a resolution in that conflict. So, we have found out that that we are. Let me see here. Putin has found out that the U.S. was also a shell producer. Do you mean shale producer, or it was only a able to produce? I'm not sure what you mean there, Bram. Let's talk about that. All right, so interesting question here. So I actually used to use Upwork a lot more than I do now in the past to do a variety of different things, and so I don't have an opinion so much on what it's like as a stock to invest in. And I've considered a lot of things when it comes to, and I don't own any Upwork, by the way. Um, and I've considered this in the past that more and more services are moving towards an independent contractor model, right? Just to get off of oil for a minute here, and let's talk about a question with an individual stock here or individual company. I like Upwork. I've used them in the past. Using them has been relatively seamless when I've gone with people that have lots of reviews. And not even all the reviews have to be positive. As long as they've got lots of reviews, I found it really seamless to work with people from Upwork. And I've had people do professional writing before, programming before, artwork before, all kinds of things for various businesses that I'm involved with. So I think it's a very useful service. I don't know exactly how profitable they are. I also know that the supply of people moving towards being independent contractors, that is not going to shrink in the near future. That's only going to grow. Okay. And yeah, and that's only going to grow at this point. So I do see that their business is probably going to get larger and larger and larger. I'm not sure if individuals who are on that platform will end up making more and more money as more and more people get on there. But that remains to be seen. This is a stock that I'm going to keep an eye on. I don't own any at this point, and I haven't done any. I haven't taken a look at the financials probably in about a year for this company, so I don't have anything current to say about them. Dewey says, bad joke, shell munitions. Okay. Actually, it's a bad joke, but it's not entirely a joke. So a lot of money has been recently set aside with in congressional legislation to actually spur production here in the U.S. So if you are in Huntsville, Alabama, if you are in San Diego, California, or and if you are in where's that in Virginia, Norfolk, Virginia, at this point, you can expect a lot of money to come your way in the form of congressional allocations towards defense production. There was a lot of money set aside for manufacturing of defense material at this point, and that's going to be drones, of course, rockets, shells, that sort of thing. I think that Putin has probably underestimated the reserve production, industrial production capacity we have in the United States, which every opponent of the United States has always underestimated. They simply cannot understand how much we can produce once we put our minds to it. That's not to say that Russia couldn't do that either. They did that in World War II. They took their entire industrial base, moved it over the Urals, and essentially just the entire country became a factory. And eventually they were outproducing Germany so badly that that's kind of what turned the war for them. They don't have the organizational capacity to do that at this point. Although they are improving their organizational capacity, just like anyone would naturally, I don't think they're going to do that. And they don't understand that even without getting involved, and they should understand because they were one of the primary beneficiaries of this, that even if we don't get involved directly, our ability to provide material without it affecting our economy that much is actually enormous. So, yeah. So yeah, and this is the thing. So the same organization, back to oil for a second, the same organization I was talking about, the U.S. Energy Information Administration, put this out on December 6th. There'll be a new release on January 10th when it comes to global oil markets and production. And so back when they made this, the spot price of Brent crude oil was $91 a barrel. I don't know where Brent ended up today. It may still be in the low 80s. But it may still be in the low 80s at this point. But they're predicting that it's going to reach $100 a barrel and stay near that area for 2023. So they think that in $90 a barrel, that Brent prices will be back above $90 a barrel beginning in the second quarter of 2023. And although we expect some downward price pressure, it could emerge in the second half of 2023. That pressure will likely be balanced by the ongoing possibility of supply disruptions or production growth that is slower than our forecast. And we forecast that the Brent crude oil spot price will average $92 a barrel for all of 2023. That would be an average for all of 2023. I would suspect that the period between May and October, we're going to see it above $100 a barrel, which, like I said before, provides some opportunity for near-term trades. This is not something that I do, right? I'm a long-term investor. This is something that I would have done plenty of times in the past. But now, I'm not adding any oil to my long-term portfolio, and I haven't done so for some time. I'm thinking about it, but I haven't done so for quite some time because of a variety of longer term trends. I'm talking 20, 30 years in the cycle of trends here. But it is something that you may want to consider at this point. So yeah, let me open it up to more questions now. If you guys have any questions about particular stocks or or what's going on in the stock market today. And I guess you did hear the announcement as well of that the Strategic Petroleum Reserve is looking to be filled back up at this point. They've announced a series of purchases. I don't remember how many million barrels a day it is, but it's quite a few. Yeah, markets got hammered again today. That wasn't any fun. And it hasn't been fun for a couple of weeks. Let me say that much. We do take a look at Upwork here. Upwork Inc. And like I said, I haven't taken a look at anything. This is just a look. I did a here and that video. To be honest with you, I'm interested in that. But I've got to start branching out beyond the things that I think are cool and start looking at what would make a better diversified portfolio for my viewers. So I'm happy to take suggestions on companies that I should be looking at. So Don Caesar Shadum. Hey, what's going on, buddy? Yeah, texting. Yeah, don't text and drive on my account. It's not that important, and I'm here every Monday and Thursday as I can. Tomorrow, actually, I'm going to be working at my daughter's wrestling tournament during the day, so I won't even have time to work on a video tomorrow, and then I teach jiu-jitsu at night. So let's see here. Annual earnings growth actually looks fairly good. The increase in losses kind of concerns me, but not really. Large, like I said, largely big companies do in growth mode here, and they're actually likely to have increasing. If we do go through a recession, this is one of those companies that is likely to see an increase in earnings, just like it did in 2020, from 2019 to 2020, and is likely to see another increase in earnings in 2023. So the last 3 quarters, they've managed to beat earnings, and they beat it rather handily. Let me see here. Quarterly earnings look to be growing fairly steadily, as well as losses don't look too bad. And for losses look relatively stable at this point. Let me see here. Let's take a look at financials. And sometimes, but I'm looking to upgrade my connection. Some variety of and sold me on their service to have 300 megabit upload, which is going to be faster than what I've got now. I think we've got I'm not sure what I have upload. It's not that. I think it's only maybe like 10 megabit or something. So I personally have an ethical problem investing in oil. Bram, I don't have an ethical problem investing in oil. Regardless of whether or not I like oil companies. Put it this way, I don't like power structures for the most part. And I don't like how much power oil has over global affairs. And I don't like the effects of 100 years of energy wars, more than 100 years of energy wars. But oil is you're going to have to use oil no matter what. It's in all kinds of plastics. And there will one day be a replacement for those, probably something like algal, basically using bioengineered algae to produce plastics is probably going to happen in the future, one way or the other. So that is, and that's the reason why you can't entirely avoid using petroleum products, no matter what. Petroleum companies are still going to be around. But I think that 2 decades from now, we're probably going to see a 25% reduction in oil use. 50 years from now, we're probably going to see a 50% reduction in oil use overall for the economy. And a lot of companies will not be able to survive. And this is one of the reasons why I haven't made any additional investments in long term, long term oil investments. But there's, like I said, I don't, I have an ethical problem with what they're doing, but they're going to have to do that no matter what because the world is dependent on that. So I'm very much about investing in a world that breaks that dependency because I think it reduces the need for conflict. The oil is one of the things that is fueling the conflict right now in Ukraine. It has fueled Middle East conflict for over 100 years, and oil was and natural gas were supposedly going to be the primary weapon that Putin was going to be able to use against Western Europe and against the United States, and that has failed so far. And I think that the quicker we replace oil as our primary source of energy, the easier that is going to be. So let me see here. When I'm taking a look at cost of revenue, of course, we've seen an increase since 2008. And that's what I'm looking for now more than I have in the past is cost of revenue. We're looking at gross profit here. Gross profit, of course, this is before all of your taxes and depreciation and all that is put together for Upwork. That's income. So yeah, Anthony, nothing here jumps out at me as particularly dangerous in terms of their revenues. So it doesn't look terrible. I mean, they're not profitable, but a lot of companies we invest in aren't profitable. It's significantly more dangerous now because of the cost of and availability of capital. Let me see here. They don't have a lot in the way of invested capital, working out, total debt. We have seen a really large increase in debt, and we saw most of that in 2021. That's not a good sign. The composition of that debt could be concerning too, right? If a lot of that is fixed interest rate, and the issue we're talking about like bond issues, that wouldn't be a problem. If it's debt that is on floating interest rates, that could be a problem. Let me see here. And there's this whole like floating rate debt that's being issued by that was issued by a lot of companies, are issued by a lot of banks to companies in 2020 and 2021. Interest rates were still really, really low. That's going to change now. Let me see here. Do you think that Amazon could pay dividends one day? I think that's almost a guarantee. And I think that at some point they're going to start paying dividend at first. Apple hasn't paid a dividend in the past. I'm pretty sure that dividend that Apple started to pay was started when Steve Jobs was not president of the company. And if you notice that, and just like Nvidia's dividend as well that they pay, it's ridiculously small, and it grows by about 10% a year, but it's so small to start off with, it doesn't matter. Amazon would be a different case. I expect when Amazon started to pay a dividend, it would be a healthier dividend. And it's also going to be in a case where they start to see that their growth is going to be incremental rather than exponential, as it has been for a while. So I'm trying to think of the best case. I mean, the best case of where a company started paying a dividend is probably Microsoft, where I think they didn't start paying a dividend until about 2000. And that's essentially when the sort of laptop wars were over. I'm sorry, the desktop wars were over. That is essentially when they basically 90% of the world's the world's computers were Microsoft computers. In most software spaces, they were at least the largest player in most software spaces operating system. And at that time, they looked faster. Can we grow? What can we do to reap shareholder equity? And that's the point they started to consider paying a dividend. And Amazon maybe not there yet, right? When I look at what their plans are and what their expected growth is, I don't think they're there at this point. But within the decade, I think that Amazon could start paying a dividend, especially as we see competition rise. They're going to need something that supports the price of that stock beyond simply what you think future cash flows are worth. There's going to be a need for current cash flow in order to assign a value to Amazon, especially if we start to see competition really start to arise there. So I do think that Amazon not just could start paying a dividend, I think they'll start doing it within the next decade. It would be just about time in the lifetime of a stock, right? I think that look at the evolution of Microsoft, and that's probably the best in terms of a stock and when they started to pay a dividend. I think that's probably the best comparison to make there. That Amazon is essentially the Microsoft of retail. Yeah, and in terms of their actual products, of course, that's a tool comparison. But in terms of their business cycle, I think it's a very, very good um, so that take on what concerns me with everyone right now is the cost of capital. Um, so let me see here. Anyone else have any questions about any stocks? Go ahead and let me know. Let me see. Or if anyone has any suggestions as far as what other industries you want to see me branch out in, I do research stocks all day long, every day. I just don't necessarily talk about those on my channel because I'm not sure exactly kind of what my audience would like to hear. Um, Trying to get out more in the way of regular videos for my channel, but my challenge with my time is something that, dang it, I have a hard time even comprehending. Every time I have a free moment, somebody calls me to fill that moment up, and I'm kind of sick of it. But I also have had a lot of like obligations with family and stuff lately. But the questions I still get are actually about technology. Those are the ones that I answer. If you have questions about other stocks, though, just remember I research those for other people all the time. Here, this is one of the news that I found baffling today. Voyager announces an agreement with Bennett's US to acquire assets. So I have shared this on my Patreon group, and I think I shared this on just briefly on a post on my channel. Is that I think that Bennett's is in a lot of trouble. Uh, a lot is a company, one of the only large accounting firms that was handling crypto clients like large exchanges. They've now dropped them. Now they're going to have a lot of trouble, finding and and finding a company that will fill them. Trouble for a lot of them. They were only a company for Donald Trump's or Trump organization. I think they're going to be in trouble. I think they may go the way of Anderson Consulting. I think it was Anderson and Anderson. I worked for them at some point actually as a consultant on the IT side, and they were a large accounting firm that was brought down by the Enron scandal. I think that there may be one or two scandals that brings down Mazars, and and one of those may be the sort of proof of reserves estimates that they've done various crypto companies. The biggest red flag that I saw with Binance's proof of was that 40% of the reserves were in their own native token to their platform. That is huge. And that basically says that their entire operation is built on a house of cards. And now the fact that Voyager Digital right here, they made the highest and best bid. I don't know what the highest and best bid. It may not be a cash bid, but the deal is valued at 1.022 billion. Voyager's existing portfolio is worth just over $1 billion and says plus $20 million of incremental value. And it's supposed to bring an end to the bankruptcy process, and it means that customer funds are going to be released from Voyager at this point. So we don't really know anything about Binance's finances. It's a giant black box of the United States or in various jurisdictions in the United States. So that's a large issue. My list bonds. Okay. We can talk about bonds, but the question has to be a little bit more specific than just bonds. I will say that's a portion of the market that I actually don't invest much in the way of bonds, almost nothing, largely because I'm simply willing to absorb risk, right? And portfolio volatility doesn't bother me at all. And it has to do with a variety of income sources that I have. That will probably not be true in the future. And I'm really talking about 10 years from now is when I'll probably start to build a better bond portfolio, right? I really don't have a bond portfolio at this point, but I worked with a regional bank that had a giant fixed income trading department, and worked with them for a number of years and got a lot of experience on that side of the financial world that most people with a Series 7 or Series 6 never experience. Like they just never experienced that. So I've always paid a little bit more attention to it than most people have. It's just been really, really boring. 2008 interest have so changes in interest rates have been so incremental that it hasn't created a lot of excitement in the bond market. Lately, there's been excitement in the bond market, and not the good kind. Last year, I think, was one of the worst years for bonds. Uh, but I think that the bond market is normalizing at this point. Once we see interest rate rises go back to about a quarter point per quarter, it looks like we are going to get some opportunity here in the bond market, and that could be very, very interesting. But I think paying attention to what the bond market is saying about the economy rather than the stock market is more important. This bear market will be over when bonds tell us that the bear market is over. When we see yield start to decrease significantly, and when we see yields start to independent of action from the Fed, is when we see the end of the bear market. All right, let me see here. Yeah, it seems like oil companies are trading at. Let's just take a look at Exxon here, and they are trading pretty high. Don't get me wrong. And let's talk about the cyclical nature of not just all company stocks. You pay attention to the stocks when it comes to the investment and bust cycle of stocks. That's going to be a little bit muted in this point because there wasn't the giant over investment in production. I think that's actually as a policy management, this is the part to invest in production later on down the road. So, like I said, I'm not looking to buy ExxonMobil on a long-term basis on $105 a share. That is not something that I would do at this point. So energy stocks cross the S&P 500 and the only sector that is above water. I would expect to see a near-term bottom for stocks, for oil stocks, pretty much established by purchases made for the Strategic Petroleum Reserve, and a near-term bottom based on an increase in demand from China. And I see that increased demand in China and those end of purchases for the Strategic Petroleum Reserve kind of counterbalancing each other a little bit until we start to see production really get strained. So the world's going to have two choices at that point. Number one is oil companies could invest in more production, or the public could be forced to eat higher oil prices for a much longer period of time, which someone in my Patreon group made the point today that wouldn't that signify that there's probably going to be higher inflation for longer? I would say that I would say that possibly not higher inflation, but almost certainly inflation for longer. Okay. And higher energy prices are going to do that. I haven't taken a look at the dividend yield on Exxon. Actually looks pretty good at 3.48 at this point. If we look at the price of ExxonMobil over the last 6 months, been fairly volatile, and we saw it peak kind of in November 11th, 2022. If we look at this over a year or so, it's been up pretty high, and now it's starting to decline a little bit. So that definitely looks like it's near a cyclical high at this point. But the price of Exxon has not really reflected that falling oil price either, neither of gasoline, by the way. And a lot of that has to do with our ability to our excess refining capacity as well. We just don't have a lot of that. And a lot of that has to do with corporate greed, passing on those profits back to the public. Of course, they're passing it on to the shareholders in the form of that raised dividend. The price to earnings ratio is actually still relatively low. And I think that the possibility here is that the probability of a recession gets mispriced, right? And we see here, do you have evidence to suggest? Yeah. Right now, I would be taking a look at residential real estate investment trusts, and I've actually been saying this for a couple of years because of the absence of inflation prior to what we're going through right now, and I would say that was going to look pretty good in the future. Now we've seen a pretty large decline in those in the last year. And that is something that I've been snapping up little by little all year long. I think the my overall portfolio in real estate investment trust is probably down by about 20 or 25%, and it's entirely unjustified. And what you're really paying attention to is rental prices in this case. Rental prices have not declined in the last year, and yet residential REITs that focus on apartments and things like that, those have declined. Even though we've seen a rise in interest rates, we've seen prices go out of control, seen rents go out of control. We've seen those residential real estate investment trusts decline in value. Things like Avalon Bay or Res or Apartment Americas and that sort of thing. We've seen huge declines in those, and I think that has produced something that's kind of mispriced. Part of the reason we've seen a decline in that is that the rise in interest rates has made that risk-free return really attractive. Like, why would you want to own a real estate investment trust paying a 3.5% dividend when you can own a 3-month T-bill that now pays 3.75%? That's part of the calculation there. And that's one of the reasons we've seen the wind kind of sucked out of these real estate investment trusts. But that is a short-term win that as the fixed income market normalizes and the yield curve normalizes, meaning that right now, short-term interest rates are a lot higher than long-term interest rates. And a lot of folks, they don't want long-term interest rates because they don't want their money tied up in something that's not going to keep up with inflation and doesn't have any possibility for capital gain. And the opposite of that is what's given you is what you have with a real estate investment trust. You have an income source that is likely to increase with inflation, and you have the possibility of course, capital loss, but as well as that capital gain. If you look at something like most of those large residential REITs, to return of about 10 or 11%, and that's over like a long 20 or 30-year period. And of that 20 or 30%, a large portion of that, 2 to 3% annually, is going to be, or even upwards of 4% in some cases, is going to be capital is going to be right or distribution. I would be wary of any REIT right now that is paying higher than like 4%. I would be extremely wary of that. Even with the price drop that we've seen in those, I would be wary at this point. The other thing that you have to watch out for is the ones that pay like 12% dividends, like I think ARR, Armor Residential REIT. They don't necessarily hold actual real estate. What they hold are mortgages on real estate, and you're getting basically, it's a floating rate fund that's based off of mortgages, where you do not really have the potential for capital appreciation in that fund. It's all about the dividend, and if you're not reinvesting in the dividend, you're probably going to see a continual decline in the value of your overall investment as they continuously distribute more money than they're actually bringing in, not supported by income that's being by. That's what's known about those investments. It's a regular part of the practice, but a lot of investors don't necessarily understand that. So if you're looking at real estate investment trusts as something that pays a dividend or distribution that is going to be inextricably linked to inflation over time, and you have the ability for capital appreciation, then definitely take a look at residential real estate trusts. The other thing you might want to take a look at is pipeline stocks, like things that are pushing natural gas and crude oil around in pipelines. They're going to be paid. The payout rates on those have been relatively low for years because of the increased inflation. I expect those to increase as we go forward. It's a little bit risky right now as we may be running into a recession. So I think that a couple months here in the future, you may have a good chance to pick those up at a really depressed price. I used to deal in those a lot more when I had that sort of clientele. clientele. I don't have that sort of clientele anymore, but it does a lot in like midstream producers, pipelines, that sort of thing. On SLV, which is not a stock, it is a real estate investment trust. I'm sorry, it's an ETF, and it's supposed to track the price of silver over time. So typically, I don't own, and I don't recommend that clients own silver or gold necessarily as investments. It's a hedge that is part of an overall portfolio strategy, right? It's not a stock, so it doesn't act like stocks. It's not a bond, it doesn't act like bonds. Ostensibly, it's supposed to have its very own behavior and be uncorrelated to those other assets. The problem is that more and more precious metals have started to become more and more correlated to the stock market as well, which shouldn't. I think it's happening because of the sort of greater democratization of the stock market. We just have a wider swath of the population that actually owns stocks at this point and owns bonds, owns investments. And now we're seeing some of those traditional correlation, those traditional correlations break down to a degree to where now it's getting harder and harder to build a well-balanced portfolio that has enough asset classes in there without correlation to sort of support your portfolio over time. So yeah, we see, is the CPI an accurate representation of the price increases the average family faces in its day-to-day finances? No, it's not. So they're looking at core inflation of things that exclude food and energy prices. Now, food and energy prices aren't necessarily the best proxy for inflation either, because of how volatile they are, unrelated to reasons of inflation, right? The oil markets are always subject to supply disruption, subject to political whims, subject to fear to a greater degree than a lot of other markets are. Extremely volatile. It doesn't make a lot of sense to include that. So there's so many periods where you want that included in a measure of inflation, and so many periods where you don't want it included in a measure of inflation. It's excluded for very, very good reasons. Because a better representation is everything that's not food or fuel. Like how are food and fuel making the price of everything else go up is probably more concerning. And by the time you see inflation sort of baked into everything X food and fuel, that's when you know you've really got a problem. So the price of food and price of fuel could go up without seeing broader inflation. That's been the case many, many times in the past, especially in the last 25 years in our low inflation environment. There have been plenty of times when the prices of food and the price of fuel has gone up where we haven't seen generalized inflation. But eventually it affects everything. And food supplies, of course, are affected by disease. They're affected by transportation issues. They're affected by weather. It's just highly, highly volatile with things that have nothing to do with like expansion or contraction of money supply. So should equity be no, equity should not be counted towards cash flow and rate cap on rental properties until you involved that equity in acquiring new properties, right? And that's one of the things that doesn't happen naturally at first for your first couple of properties. But after a while, and you start getting the ball rolling. But no, like, because I'm not expanding my property holdings anymore, I don't count equity growth towards cash flow and cap rate on rental properties. It's all about that original investment. What am I making on it? And maybe when I go to sell that's part of the calculation. If I sold this to someone else, this would be that part of the calculation. But if I start using that equity, say my price went from $500,000 to $1 million, I still owe $400,000 on it. So I borrow another $200,000, $300,000, put it on another home. Then I start putting that into the calculation there. But until that point, I really don't. I want an accurate representation of what my actual cash flow looks like and cap rate looks like. It looks like today I'm in the path of I'm in the flight path for helicopters today, and not the police kind that hover over your house looking for certain people. These are military helicopters. It looks like the 60s are going overhead today. So I may actually know a couple of people flying those. But yeah. So rental properties, although I've had rental properties for a number of years now, I can talk to you about rentals, but my life when it comes to rental properties are arranged around having as few problems as possible, and making it truly, because there are a lot of times that I have been a landlord where it has not been a passive investment. I have had to work my ass off to keep people in there, get people in there, and repair issues and put out fires. Thankfully, not literal fires. Um, but in the last decade or so, I've prioritized not having to be involved by putting the best renters in there. And sometimes keeping the best renters means that it impacts your cash flow. So I live in a market though where we have plenty of equity growth, and we've shown lots of equity growth over time as well. And this is of course Southern California. So while I don't necessarily include that in my calculation there, I know that if I really hate the property and it's really an issue, I can always dispose of it at a profit, right? That's kind of thing. So all right, guys, we are at 55 minutes, which means we're close to that hour that I dedicate to this on Mondays and Thursdays. I'm actually really happy to see questions outside of technology stocks today. I do want to see that, and I did note, Keith, that Berkshire is still buying Occidental Petroleum. Occidental is actually a really well-run company, right? They're just solid, boring, dependable Occidental Petroleum, and they are still in growth and acquisition mode. I think it's a really good company, and I actually regret not buying into them more heavily back in 2008 when I had my first opportunity to do that. That's something I really regret. I don't necessarily regret. Well, no, I would say that I regret not buying more in 2020, but I was done buying into having a long-term portfolio of oil stocks at that point. I had enough, and I didn't need to add any more to my portfolio. But no, I do think it's a pretty good company, and I look at them probably 2 or 3 times a year and like write up reports on that company as well. And this is pretty boring, guys. It's not exciting like investigating a new technology company. Like this is about how many feet of pipe they bought, how many drilling permits that uh, they applied for. And actually, did I see that? No, this was in this Twitter thread here that and this is one of the things I wanted to point out at the oil industry. And I don't know if you guys can see this, but application for permits to drill status, right? So there are like 9,000 unused permits to drill by March 10th of this year. There were more drilling permits issued, but these are the top states that were approved. So, uh, and this is the top, 10 states, right, or 8 states or something. Alaska had 8 new drilling permits. That's it. California had 271 new drilling permits. Eastern states only had 29. Colorado had 543 drilling permits. That's part of that shale area. Montana, 756, also part of that shale area. Nevada, 4. New Mexico could be, they just got a lot of untapped potential there. Utah, Wyoming. What is the number one state that was not mentioned in drilling permits for applications for permit to drill? And this is APDS is approved on federal land, Texas, right? Because you don't need a federal permit to drill in Texas because none of the land is federally owned. Texas is something like 98% privately owned, right? So all you need there is to contact the landowner, contact the person who owns the mineral rights, and get a state permit. That's it, right? And that's the way it is for a lot of states where federal land ownership is really low, and then it's really in the west does not include like kind of Texas. Is really New Mexico and further west than that. A lot of the West is, you have states that are more than 40% federally owned. So that's where the majority of permits are issued. And a lot of the Eastern states have a lot less in the way of federal land. And so you don't see those permits issued there. And I didn't realize how many people didn't know. Like I had someone that I know that I was talking to that was trying to claim that the Biden administration was trying to exclude Texas from drilling. And he mentioned the fact that there were no federal drilling permits issued. And he didn't understand that you are issuing permits for drilling on federal lands, and there is no federal land in Texas. Less than 2% is owned by the federal government, whereas a state like California, 48% of the land is owned by the federal government. I think in New Mexico, that number might be as high as 70% of the land in New Mexico is owned by the federal government. And this is why you have these giant range of permits there. The rest of those, they're not going to the federal government and asking for permits. They're going to private landowners and asking for permits to drill. But regardless of that, the United States cannot order companies to drill. They cannot order without the War Production Act or the Defense Production Act invoking that. They can't order companies to pump more. They can't order companies to drill more. These companies are free to do so at any point they want to. They're free to invest in expanding capacity anytime they want to. They haven't done it, and they've kept prices high because they thought that was the prudent economic thing, or economically prudent thing to do. They may be proven relatively correct here. And like I said, the whole point of this live stream was to discuss the fact that that I think that there's going to be a pretty large increase in oil prices here in the future. Jesus, not sure you want your email going out, Jason. What email was that? I've had my email in the description of some of my videos for like years. And yes, that email address is full of junk. And yes, I do use it for other business purposes. But I'm getting a handle on that at this point. So yeah, let me see here. Any other questions, guys? We're at about an hour, so I think I'm going to take off here. But just wanted to make my points on the oil industry today. I didn't really want to talk about Twitter. By the way, one last thing. I got to talk about Elon today. Anytime Elon Musk comes out with a poll, I'm ignoring it from now on. Just ignoring it, right? And that is Gmail. Did my email address go out? Yeah. I'm ignoring any more polls that he puts out. And I'll tell you why. Elon Musk went to the World Cup and was seen sitting next to I can't remember the guy's name. Ibn Talal. I don't remember the guy's last name, but anyway, Alawi, I think. He was a major financier in Saudi Arabia, and he was also seen sitting next to a couple people that I recognized from the UAE, which meant that he was there to beg for money, because otherwise he'd be sitting with other billionaires or something like that, which means he was in the United Arab Emirates to ask for money to rescue Twitter. And if I were in the sovereign wealth, I was a manager of a sovereign wealth fund, I would have refused to invest in Twitter. But if they did agree to invest in Twitter, I can guarantee you that one of the conditions or stipulations is that you need to appoint a new CEO. You have to step down as CEO. You can't run this. And I'm sure that wasn't said directly, because that's not how Arab people do business. It was suggested in numerous ways, and said indirectly that we're not going to invest in you in Twitter unless you step down as CEO. So he comes back from the World Cup, or posted after the World Cup game, says, hey, we're going to do this poll. Should I step down? Just pretending like it's all being done democratically. But I can tell you that decision was made by the people who are going to backstop Twitter. So the people that are most afraid of Twitter and what it could do to their position in society are the ones, and who have the least interest in free speech are now the ones that are going to be the primary financial backers of Twitter. I'm sure that's coming. I'm sure that's coming. There's going to be an announcement at some point of a large investment on behalf of not the Saudi Sovereign Wealth Fund. It's going to come from an individual from Saudi Arabia, an individual from the United Arab Emirates, from Bahrain, or from somewhere in that region, and largely so they can say this doesn't have government fingerprints on it, but it will. It will have government fingerprints on it, and there are going to be demands, and they're going to have access now to location information, to data, to contacts, all of that stuff once they invest in the company. So the idea that Twitter was bought as a way of saving free speech is completely dead, in my opinion. I liked the idea at first. I wanted to believe in that idea, but the behavior of Elon Musk and who he's gone to for funding, the people who are most interested in not having free speech, which guarantees the failure of the project overall. And I think that the failure of Twitter is going to drag down a couple of major investment houses as well. They've taken entirely too much risk, and it may drag down some companies that seem unrelated. Let's remember that Binance, however you pronounce it, invested almost $500 million into Twitter. They didn't loan Twitter the money. they invested. If that investment goes bad, that looks very bad. So anyway, just my thoughts on markets today. Just my thoughts on the oil market. And I think that I'm going to end there. And anyone that still loves Elon Musk, I'm probably losing them as a subscriber. My intent is not to unfairly criticize. There is a lot there to really criticize right now when it comes to his behavior, when it comes to what he's told us, and how his intentions now definitely don't look the same. And I think that involving the Saudis or the Emiratis in a free speech project is self defeating. Anyway, thank you very much, and I will see you on Thursday.